Thank you everybody for joining. Welcome to our Kristal webinar and Fireside Chat, where we're looking to explore investment themes around commodities, credit, and the themes in between. Thank you for joining. Before we get started, I would like to go to our disclaimer. Please note that all the information and discussions in this webinar are only for general references. We are making this available for information purposes only, and this does not constitute a solicitation or a sale recommendation of any product. If you wish to receive a solicitation, please contact us and we will go through the suitability assessment before transacting. The contents of this webinar has not been reviewed by any regulatory authority, and you are advised to exercise caution before investing in any of the products mentioned here. And you should also not invest purely on the product-based information from this webinar alone. And if you're in doubt, please obtain independent professional advice. Furthermore, please note that this webinar is a recorded session as well. So with that, I would like to go and introduce our guests for today. I'm joined by two very highly regarded professionals from Tribeca, one of our partners. I would like to start with John Stower. He's the portfolio manager of the Tribeca Asia credit strategy. And he is pursuing an active long-short approach, investing in high-yield fixed income products in the predominantly Asian credit market. He has got extensive experience and deep knowledge of corporates across the Asia-Pacific region, over 12 years of experience with Farallon Capital Management, and he has also extensive expertise in capital-intensive sectors, especially in the metals and mining, energy and industrial sector, which are a key focus of the strategy. So therefore, I think he's very well positioned to join us with some of the insights that he might have to these sectors today. John holds a Bachelor of Arts degree from Princeton University, where he graduated with honors. And also a little side detail, he is a leading scorer in the Princeton University water polo history. And he was a professional player in the Australian National Water Polo League for a year. Welcome very much. Welcome, John, and thank you very much for joining us for today's talk.
Thanks a lot, Thomas. Thanks for having me.
Then we're also joined by Todd Warren. He's the portfolio manager of the Tribeca 2050 strategy. This strategy is focused on decarbonization beneficiaries such as carbon credits, green chemicals, metals, green food, and industrial innovation. He's also a partner of the Tribeca Global Natural Resources Strategy, and he leads the research coverage of key sectors such as energy and bulk commodities. He has over 2 decades of specialist research and portfolio management experience in the natural resources sector. And prior to Tribeca, he worked with Colonial First State Global Asset Management in London and in Sydney. Todd holds a Bachelor of Commerce from University of Newcastle, and he's a CFA charter holder. He's also a company director of the currently ASX-listed Tribeca Global Natural Resources Fund. Thank you very much for your time, Todd. I'm looking forward to hear your insights.
Thanks for having me, Thomas.
And last but not least, a little bit about myself as well. I'm your host for tonight, today, sorry. And I've joined Kristal in 2019. I've been spearheading the advisory efforts. I transitioned in late 2021 into a different role. I'm now responsible for the trading and portfolio management at Kristal.aI, mainly focusing on our VCC incorporated funds. I currently manage 2 funds at Kristal myself. One is the Kristal Founders Fund, where I'm a co-portfolio manager together with our founder and CEO, Ashish. It is a multi-asset macro strategy with a global focus. And I'm also the portfolio manager of the Future Vision strategy. This is an equity strategy which is focusing on key sectors that will be of increasing importance in the next 10 to 15 years, predominantly the whole topic around energy transition, renewable energy, food and water security, biotech and genomics, and also cybersecurity and AI. Prior to joining Kristal, I had 15 years of experience with JP Morgan in in Singapore, where I've been a portfolio manager. I also have about 10 years across LBBW Singapore, HVB Asset Management in Hong Kong, and Bank Austria in Vienna and Singapore. So going to the agenda for today's Fireside Chat, as you have seen in the invite, we're going to be talking about secular commodity-linked themes that we have currently in progress, specifically to energy transition, ESG. Then we want to take a quick outlook on traditional commodities. Lastly, last question will be around the supercycle investment opportunities in Asia Pacific. Please note in this webinar, we have a Q&A tool. Please use it to ask your questions anytime. We will keep track. I'm also joined by Gautami from Kristal. She will be helping us to go through the polls and also through the Q&A. And if you have any other questions, if you're not able to answer them during the webinar, please also send us an email to support@Kristal.ai, and we will get back to you, or someone from my team will get back to you. Since we also have a few attendees that are new to Kristal, let me quickly spend just 2 minutes about us and who is Kristal. So we were founded in 2016 to break down the barriers and offer private wealth solutions and products at a scale in a personalized manner. As you can see from the global chart here, we are currently active with presence in India, Singapore, Hong Kong, and Dubai. With regards to the what does it mean, democratizing and fractionalizing access to private banking? Usually you have very high barriers of entry, even as a mass affluent and wealthy person. In private banking, we see thresholds for alternative assets, private assets, anywhere between 1 million to 25 million. With our fractionalization, we are able to offer these kind of products in the hundreds to 25K bite-size things that allows investors to build a diversified portfolio. Of course, we have customized model portfolios. We have access to Kristal private markets, which are pre-IPOs, private equity. We are offering structured products and bonds, and also hedge funds on the platform. On the next slide, you can see just a quick overview of the entire enterprise wealth management solution that we have, and all the building blocks to it to arrive at the wholesome offering for our clients. So if you have any more detailed questions, if you would like to get in touch with our advisors, again, please send us an email to support@Kristal.ai. Yeah, with that, I think we can go into our agenda for today. I don't want to keep you waiting any longer than that. Maybe we can start with a brief poll just to get a little bit of a sense as to current positioning, or kind of like our guests, how you are currently invested in the commodity sector. We can take then the results after we went through the first round of questions. So we would like to know what percentage of your portfolio is currently invested in commodities. You can also include commodity-related investments, for example, copper mining equities can be counted as well to that. And we would be keen to find out more about your current investment here. Maybe while we are waiting for the results of the poll, let's start with our first topic of today. So secular commodity-linked themes for the next decade has definitely been one of the investment trends over the last 4 years. We have gained a huge attention in the segment, especially ESG, renewable energy. In the period of 2019 to 2021, we have seen a strong outperformance of any ESG-related investments and renewable energy investments. If I compare, for example, iShares Clean Energy ETF versus the S&P 500, there's over 150% return over that matter of 3 years in that subsector. And that has changed dramatically going into 2022. So I want to ask our guests, what do you think is the reason for this? Has it been unreasonable valuations? Have we seen the end of the trend of the ESG investment theme? Or is it more of a liquidity-related pullback that is related to the sharp rise in interest rates that we have seen over the last 12 months? So maybe Todd, if I can start with you and get you views on that.
Yeah, it's an interesting place to start, Thomas. ESG investing is I think going through a bit of a maturation process, for want of a better term. And I think there's a combination of factors for that. As you rightly pointed out, there was some very strong returns to be had investing in some certain key thematics that followed that ESG trend, certainly renewable energy being one of them. But I think what it also saw was, frankly, a flooding of money to that sort of key part of the market. And frankly, the ESG exhibition of ESG thematics, I don't think was particularly in depth. And I think we're starting to see ESG 2.0 start to take place. And what I mean by that is renewable energy is frankly an easy way of exhibiting a decarbonisation thematic. Obviously, if you look at how our entire economies and the carbon footprint is exhibited throughout the economy, the easy or low-hanging fruit in terms of decarbonisation is certainly taking away carbon through the fossil fuel consumption, and of course switching that over to renewable energy. Now, what we did see though was the reality that was very much enabled by low interest rates, because the reality is that the returns profile of much of the renewable energy space is frankly not very high. So it really required low interest rates to I guess, generate a suitable return. What we are seeing now, or certainly what we've seen in the last 18 months or so, is rising commodity prices, certainly in the fossil fuel space, oil, gas, and coal. And that has forced a bit of a change of thinking for much of the generalist space. For a while there, these commodities were, cheap. And so from an investment perspective, they weren't very attractive. Now, what's happened is it's a very simple case of economics 101, where low commodity prices meant that there wasn't any money being invested by the producers of these commodities, such that very quickly we found ourselves in a situation where supply rolled off, and that supply response has been met with demand being at continued relatively elevated levels. I think there was an expectation that we would see demand for these commodities roll off quite quickly as the world embraced decarbonisation. But the reality is we can't switch easily from fossil fuels to renewable energy. It's called an energy transition for a reason. It's not called an energy switch. And I think what the world is experiencing now, and of course, what's happened in Ukraine, is a sad and stark reminder of the realities of the world, in that what's happened here is we've got a longer-term decarbonisation desire being met with very short-term and severe energy security needs. And that's forced a rethink of that whole ESG conversation. Obviously, rising interest rates, coming back to my point earlier, has also had a bit of a negative impact on some aspects of renewable energy, for example, and force people to rethink how they pursue a decarbonisation goal. And I think where we come at it is not a divestment approach. We find that you get a better response from these companies if you engage with them. And indeed, the way we think about it is, it's easier to get a better response if you're inside the tent agitating for change rather than outside the tent throwing stones. So there's a lot of things going on in the ESG space, but I might throw it over to John for his views.
Yeah, thanks, Todd. I'll just add to that. And I think, obviously we've been using this term internally, ESG 1.0. And I think it was coming out of COVID. It had been happening for several years, but coming out of COVID, it really picked up steam, kind of like a snowball running downhill, tremendous amount of attention, fund flows. And, obviously we believe in that theme. I mean, the origination of that theme is all very positive. So obviously we want the companies we're invested in to improve their, environmental, social, governance credentials and to decarbonize. But like a lot of, hot themes in the investment space, it morphed into something a little bit different. And, everyone who had any sort of company or investment project, decided that they were quote unquote ESG, right? And it sort of morphed into this disturbing trend where, creating an exciting story was more important than creating a business, a profitable business, or at least one that has a path to profitability. So, and, that just wasn't sustainable. So, whether it was unreasonable valuations, liquidity rate pullback, sharp rise in interest rates, I mean, it was bound to, that bubble was bound to pop at some point. But, I think it was really the rise in interest rates that kicked it off, as Todd mentioned. And, obviously, if you have interest rates at zero, you're happy to invest in businesses that are going to create growth in the future because, money now is a lot cheaper. But now that you have short-term rates at 5%, you can't afford to forego that 5% risk-free return by, investing in an unprofitable company or valuing a business line within an existing company at a high valuation if it's not going to produce any near-term returns. So, I think obviously over the past 6 to 12 months, the wind in the sails, a lot of these companies has come off, has come out of the sails. And obviously we've seen share prices come down a lot. And, that's sort of along with this Russia-Ukraine situation, like Todd mentioned, that's really, I think, create a lot of soul searching in the space in terms of what investors should be focused on if they want to be a part of ESG and this thematic. And so, I think we really feel like ESG, decarbonization 2.0, it's really going to come back to the real economy and move into these picks and shovel plays. And, within that, we're really focused on battery, minerals, mining technology, renewable energy, things that we're seeing as, potentially less exciting or if I could use the word sexy, 12 to 14 months ago, but are actually producing strong profits and returns. And, I think increasingly, and this is, quite important, increasingly we're even in any business, even if it doesn't sort of fit that ESG thematic, we're looking for opportunities to invest in companies that can use their cash flow to reinvest in decarbonization at strong rates of return, because this creates this virtuous cycle where you have compounding profits and decarbonization that's really attractive for investors. So, I think the market has started to come around to our view really over the last 6 to 12 months, and we think that's going to continue over the next couple of years.
Yeah, there's some interesting points to start with, and thanks very much for your detailed response. So I do agree with that as well, that we see a lot of the companies previously where valuations have just been unrealistic and too stretched. That's now at much more reasonable levels. Also, that you have this washout and consolidation of companies, separating the bad from the good, so to say. But Todd, you made an interesting point, or actually both of you made this interesting point about the acceleration of the transition through the events in Russia and Ukraine over the last year. I mean, I'm of European descent, so I've been following that very closely, and I'm very close to that matter as well. And I can say for Europe, definitely there has been a massive acceleration. In some places, it's paired with some interesting political choices, like, for example, the German decision to exit nuclear energy just at a time when they're also trying to get away from Russian gas. It's going to be interesting how that plays out. But maybe more with regards to Asia, what do you think are some of the trends with the energy transition or decarbonization? Do you think that acceleration holds also true for Asia, or is it more that cheaper Russian oil that's now making its way into Asia is actually holding back some of the efforts in Asia?
I'll jump in first, but John has a very in-depth view of Asia, so he can, I think, answer this one very well. I'll just add in a few quick comments and to say your point is well made, Thomas, that the proliferation, for want of a better term, of Russian oil, particularly into the Asian marketplace, really plays to the social benefit of the Asian populace, if not an environmental benefit. Now, I mean, I guess the question is, would that oil have been consumed regardless? Yes, is the answer. Whether it was consumed in the US or in China or in Pakistan or India or indeed in Europe somewhere, those barrels are produced and will be consumed. What is happening, of course, with the turning away of Russian barrels from the Western world is that, yes, the many of these Asian countries who are willing to purchase these Russian barrels will benefit as a consequence. Now, more broadly, though, that's probably a very flippant response with regards to China, for example, who has been very much at the forefront, frankly, of renewable energy investment. So whilst they benefit from getting cheap barrels, for example, or cheap molecules from Russia, the reality is that China has been investing more than anyone in renewable energy investment. So it's just part of the overall energy picture that will play out. Now, you know, I think it's the other aspect here, and that's why I touched on the social benefit here. ESG, and this is where it's been, you know, some of my comments may be controversial from a European perspective. I'm of the view that ESG has been capital E, small s, small g for some time now. And I think, you know, we're now just starting to realize that if you pursue E at the cost of S and G, or at least the ignorance of S and G, there is ultimately a price to pay. And Thomas, your point you made earlier about the Europeans dealing with that now, I think there was, frankly, as I say, an ignorance is certainly the S side of things, and the social consequence of that. And now we are dealing with the price from a social perspective in Europe of higher energy prices. Who are we to say, you know, in the Western world that the developing countries of Asia should not have access to cheap energy that we have obviously all enjoyed? And I think that's a factor that sometimes gets forgotten. But obviously, it's very much a requirement, in my view, of the wealthier nations of the world to not just encourage the developing nations of the world along that decarbonisation journey, but to assist them in doing so. John will have some, I think, certainly deeper views of some of the Asian marketplaces.
No, look, I think you hit it on the head there, Todd. And I think there's some quite interesting things going on. I mean, you're actually seeing a lower inflation in Asia relative to the rest of the world, which I think there's a couple of things going on. One of those can be attributed to, you know, some of the lower energy prices with, you know, potentially with, you know, in certain countries like India, China, et cetera, with Russian fuel going in there, but also with where labor markets are. But I don't think that's going to really change the broader decarbonization trend. I mean, really what you've seen over the past 2 to 3 years is that and, you know, renewable energy trend and electrification trend, you've seen all the governments come on board with this pretty much wholeheartedly across the board. And that's, you know, I think Asia was probably a bit later in that shift in terms of, you know, obviously Europeans were first and, you know, North American potentially second, and then Asians taking up the rear in terms of sort of government attitudes towards that. And partly that's because what Todd mentioned, Asia is obviously later in its economic development cycle, but every government and business community, I think globally, broadly understands the push is going into renewable energy and electrification and decarbonization, et cetera. So, you know, Asia obviously has a lot more low-hanging fruit in terms of that, thematic, and in terms of the, you know, having the highest carbon emissions, but that also means it has the greatest low-hanging fruit. And so, you know, it's already, I mean, Asia leads the world in wind capacity additions, solar capacity additions, battery storage installations. So, you know, while there is, who knows how long this conflict's going to last. It obviously seems like it's going to last for quite a while, but that will benefit Asia in terms of lower energy inputs in the near term. And that's certainly actually something we're seeing in terms of why we think Asia's set up better economically in the near term relative to what you're seeing in the US and Europe. But again, it's not going to change and we haven't really seen it change at all, the desire to invest in renewable energy and decarbonization. If anything, it's just highlighted the energy insecurity we see in fossil fuels globally. And so everyone realizes that you need, you don't know where the next geopolitical issue is going to come from. And so you better figure out how to produce a lot of your power through renewable sources, which you can do on the ground in your own country, rather than having to rely on fossil fuel inputs that may be coming from some, insecure country from a security perspective.
Yeah, definitely. I think this entire renewable energy transition, the point that you're making about you can produce it in your own country, that plays very much into this total trend of deglobalization that we have seen over the last 7, 8 years approximately, where things get more closer to home as well. But I want to make a little bit of a switch here in terms of the topic. If I look at the entire topic of renewable energy transition, while oil and gas are kind of like the blood that flows through the veins, in order to build the skeleton, we have a very heavy reliance on minerals and metals. In particular, lithium and copper are at the forefront here. Some reports stating the amount of copper that we need to achieve energy transition targets in the next 20 to 30 years is about equivalent what we produced as an entirety over the last 5,000 years, if these projections are true and to be believed. That is definitely a very strong bull case from a demand perspective. But looking at the supply side of it, we have recently seen some issues emerging in that segment as well. Chile, for example, has shocked the world in the last week of April as well, when they announced plans that are looking to nationalize or control the strategic lithium reserves that they have. Chile is one of the largest producers of lithium globally. And Indonesia, I think, is talking about similar steps for nickel reserves. These are all materials that are needed. Lithium is needed in batteries, copper you need for the wiring, in electrical energies for energy transmission lines, cables, etc. So what is your take in terms of how should investors navigate this difficult environment, where you have on the one side the relatively clear-cut investment case and investment thesis of demand is rising, supply stays about the same, you can't increase your supply to the same amount that the demand is increasing, so prices should go up. But at the same time, you have got these political risks that are emerging. Of course, also we're talking ESG, the S and the G of part of it. If you look where some of the cobalt is coming from in Africa and copper mines, etc., there's a lot of social concerns and considerations as well to be had. So how should investors navigate this environment, and what is the best investment strategy that you're using in that context?
Yeah, sure. I can jump in first on this, and Todd could add. But yeah, I mean, you're absolutely right. If you look at any reasonable projection, even the most conservative projections amongst battery minerals, graphite, lithium, nickel, cobalt, copper, etc., I mean, the demand growth just pales in comparison to any reasonable projections that we're seeing on the supply side. So, Benchmark's done a study saying we need 384 new mines across graphite, lithium, nickel, cobalt by 2035 to meet the coming demand, and that's just a massive number. And we think that across those commodities, the demand is going to be about 20 to 40 times what it is today, if you look by 2050. And so there's, we're going to need all the supply that we can get. And, you've seen this, governments, they all want more supply of these commodities to decarbonize. But if you look at the Western governments and, the US with the Inflation Reduction Act, et cetera, they all want supply from, either developed markets or friendly jurisdictions, right? And, US has obviously put subsidies in place that are going to try to drive supply from either the US or those with free trade agreements with the US. But the fact of the matter is a large portion of these commodities exist in emerging markets, right? And the mines that do exist in developed markets, have become increasingly difficult to open due to permitting issues, and obviously a lot of the capex issue, mining capex inflation issues. We've seen that a lot in Australia and the US in terms of trying to find labor, materials costs going up, et cetera. So the bar to get a project off the ground, even within developed markets, is just getting greater and greater. So, and then, that doesn't even factor in the fact that about 60 to 80% of the processing of these commodities happens in China. And so, as people get more and more worried about geopolitical risk there and looking to bring supply chains onshore, that obviously adds in another factor as well. So it's a very complex issue. I think what it means is, there will be continued supply issues in these countries, and whether that's from, supply not meeting projections because it's difficult to get projects off the ground in developed markets, or that's some political issue in an emerging market, you're going to have continued supply disruptions. But I think it's also important to look at the nuances of those. So you mentioned Chile and Indonesia. I mean, I think actually on the surface, those could be seen as very similar, but actually I think they're quite different in terms of what's driving what's happening there. So Chile, that initially started as a leftist government, looking to effectively nationalize resources in one way or another. And, I think obviously that's going to be a pretty big issue for lithium, copper going forward. Obviously we'll see that. I think the mining bill's getting revised, and we'll see exactly how that shakes out. But Indonesia, actually, if you look at it, this is really a pro-business government looking to promote the downstream industry. So if you take a step back to what Indonesia initially did about 10 years ago was they banned export of unprocessed ore in nickel. And effectively, when this happened, everyone looked at this and said, "Okay, this is typical Indonesia. This is never going to work out." But actually, what we've seen over the past 5-6 years, there's been a massive investment in processing of nickel in the country. There's been tens of billions of dollars invested and in downstream processing, and it's been a massive win for the country. They've become largest nickel exporter. It's actually fixed the sovereign balance sheet to a large degree. It's pushed the current account from deficit to surplus, and there's more and more investment coming. So I think when they're actually not looking to nationalize the resource per se, they're looking to effectively reduce the exports of unprocessed ore and promote the downstream industry. And they're going even further into battery minerals, batteries themselves, potentially even electric vehicles. So I think it's hard, you can look at this sort of emerging market risk in the same lens, but I think it's important for investors to understand the nuance in terms of what's driving that. And you could, in one sense, just say, okay, we want to invest in developed markets, but I think you miss out on a lot of the exciting resources stories. And you also have to understand developed markets have a lot of risk as well in terms of getting projects up and running.
Yeah, look, I think John's touched on a key thing. In developed markets, typically the biggest challenge is permitting. The challenge is not necessarily funding; it's actually getting the permit to actually extract the minerals from the ground. And that is only getting harder and harder. As a rough rule of thumb, historically, the rule of thumb was the time frame from first successful exploration drill hole to first production was typically a 7 to 10 year time frame. With this increased challenge around permitting, that average time frame is now 15 to 20 years. So even if we find something, it doesn't come out of the ground instantaneously. Indeed, it's a very, very long time frame before successful extraction of those commodities. The other thing I would add to this whole discussion is the feedback that the capital markets have given to the suppliers of these commodities, the mining companies themselves. We had the boom that was driven by China urbanization, and the response, of course, was higher commodity prices. And in response to those higher commodity prices, mining companies invested in growth, and their management teams, importantly, were incentivized to do so. So this was very much Economics 101, and it all happened as you would expect. Subsequent to that, we had this flood of commodities that entered the market, all at the wrong time as commodities were cooling again, as economies were cooling again, and commodities collapsed and mining stocks responded as you would expect. They went down, and it was a very long, drawn-out bear market for these companies. What happened then was the capital market said to these management teams, whatever you do, do not reinvest your money in the ground. We want you to pay back your debt. We want you to buy back your stock. We want you to, if anything, pay us some money back in a dividend. But whatever you do, do not put it in the ground. And indeed, we will change your incentive structures in order to support that. Now, with the timeframes I'm talking about now, about 15 to 20 years from first drill hole to first production, there is no management team in the major mining houses today that is really incentivized to bring that new supply to market. So even if we are seeing increased commodity prices, we're not seeing that supply response. And that's just leading to a more drawn out and frankly more challenging response time with regards to this shift we're seeing in the demand to driven by decarbonisation more broadly.
Fascinating. Yeah. I think the one point that he touched upon, what caused this shift in company behavior, we have already one question from Rajiv on why mining stocks have not been performing over the last 1 year, and despite the assumption that EVs will drive metal and mining market upwards. Would you say, is it a fair answer to that question? Would it be that we had this situation where it's basically coinciding while we have that outlook on tight demand, rising demand and tight supply, but what's been playing out over the last 6 to 9 months is more the fears of a global recession that has been depressing that segment, paired with the higher rates?
Yeah, without a doubt, that's been, so what you've had, yes, certainly over the last, well, probably a bit longer than 12 months, frankly, has been that growing fear of certainly a Western world recession. But in concert with that, of course, certainly in 2022, was the fact that we still had the world's largest consumer of commodities, China, in a COVID lockdown situation. So you've got the biggest consumer locked behind their front doors, in some cases literally, and this growing concern that the Western world was going into recession. So going to be some demand destruction there. So short-term economic factors to deal with doesn't change the longer-term fundamentals that we see playing out over many, many years.
Yep. Cool. I want to go back. We asked the poll questions at the beginning of it. So what's the percentage of the portfolio invested in commodities? We have less than 10% is the majority of our participants, and then we do see some relatively more aggressive 20 to 30% allocation for just 6% of our audience. So thanks very much for sharing your insights here. Maybe we can do another poll that we have prepared, which is when it comes to investment decisions, do you factor ESG metrics into your investment decisions? We will get to that also shortly then afterwards. I want to take a little bit where it's fascinating topics, and I think when I spoke with John and Todd in the run up to that fireside chat, we all three of us agreed we could probably fill a few hours of conversations around these topics. But maybe just to hop a little bit for the remaining 20 minutes that we have into your outlook on traditional commodities, specifically energy, copper, agriculture. I think a lot of it has been touched upon already in our conversations so far, but one of the questions is about cheap valuations for oil and gas companies that we have. Energy has not been performing well due to the recession fears, but do you think that investing at this stage, I mean, we were saying we still need fossil energy to achieve energy transition, but from an investor's perspective, if you have like 5 5 years investment horizon, for example, is there still an investment case to invest in companies since there's still demand that needs to be satisfied for the coming years?
Look, I think absolutely is the short answer, Thomas. I think I alluded to it earlier. The Ukraine situation was a very dramatic reminder that we are undergoing an energy transition, but we have very immediate needs. And what you've seen, and this is, I touched on it a moment ago with regards to the mining sector, and how we've been beating these management teams over the head saying, whatever you do, do not put your money in the ground. The same is true of the energy sector, where we have told these guys, whatever you do, you have been growing too fast for too long, and you've been doing that really only with the support of the equity and debt markets because you've been outspending your cash flow. That has since changed, and these management teams, to some degree, have got religion. Now you look at where does the world's primary supply of oil and gas to some degree come from? Clearly, OPEC nations is one aspect, and in particular the UAE and Saudi Arabia, but obviously also the US. And the US really came of age as a very significant supplier of oil with the advent of unconventional oil and gas development. What's taken place over the last few years is the CapEx profile of this sector has collapsed, and it hasn't recovered. So as the oil price collapsed during the GFC, we saw capital plans get crushed, and they just simply haven't recovered to anything close to pre-COVID levels. Now, the reason I say that is that even in a scenario where we do not see significant growth in demand for oil, you still need to invest significantly in the supply of oil just to meet existing demand because of what's called the decline rates. Now, without going too much into technical terminology, the best days for an oil or gas well are the first days it's in production. And after that, the pressure inside that reservoir declines. Think of it like a balloon. When you release air from a balloon, it comes out fastest at the start, and the rate that air comes out slows as the balloon deflates. It's the same for an oil and gas reservoir. So if to put that into numbers, the oil market today is around about 100 million barrels a day of consumption. If we weren't to drill another well at all for 12 months, the supply of oil would decline to probably 85 million barrels a day. That's just through natural decline rates. So and that's going to happen every single year. So even in a scenario of the world transitioning to a decarbonized world, we need to continue some degree of reinvestment in oil and gas production just to maintain the delivery into the demand that still exists. So that's a long-winded answer to your question, but in our view, we're going to continue to see demand for oil increase, albeit at a slow rate. It's probably, as I say, 100 million barrel a day market today possibly grows to 110 million barrels a day at its peak, in the next several years' time. But the point is, because of that decline, the natural decline rates, we need to continue to invest. And it's not coming from your traditional sources. And the OPEC nations, or particularly Saudi, have clearly demonstrated a desire to defend an oil price that's frankly in the $70 to $80 a barrel range. I think you're in for a fairly constructive environment for the next 5 years.
Yeah. In that context, actually, I probably, this is more question for John because he's looking at fixed income and credits on that front. But with what you have been saying, what I also noticed, and I was actually talking with a guy in Europe not so long ago, is it's incredibly difficult to get any funding from banks, financial institutions, because of ESG criteria that they have, limitations that they have. They can't even drill or get loans to do any projects. So John, more for you, is this also manifesting itself in the credit space? Do you see that in a similar way, or if I may even spin the question a little bit broader, do you think in the current environment, the opportunity for that investment, is it more credit and fixed income or equity?
Yeah, look, I'm going to be a bit biased because obviously I'm credit focused, but I do think it's actually a great opportunity for credit if you have the flexibility in your mandate, or you're unconstrained from that perspective. Because I mean, as investors, we look for opportunities where there's a supply-demand mismatch of capital, right? So where either for whatever reason there's something that's misunderstood, so there's not a lot of demand for it, but it's a great business, or it's an industry that people are constrained from investing in, that actually is producing good returns. So obviously we are very focused on the decarbonization and thematic, but we do really believe it's a transition, and you can't go to net zero overnight, right? So there is a just from a, and you think about ESG, right? I mean, if we turned off fossil fuel production overnight, I mean, the people who are going to disproportionately get hurt are people in less lower income countries, right? So we I think we have to think about it from that perspective as well, and be smart about it. And we are seeing, as you said, no one can get any funding for if you're in the oil and gas space, or say coal space. There's really very limited bank lending if you're not an existing customer. So there's certainly no new projects, but even companies that are already producing are effectively getting gradually taken off the existing client base of a lot of these large banks. And so from that perspective, you're seeing credit spreads and yields for companies in these spaces at 2, 3, 4, 5, 6% higher than where you'd see similarly rated credits in other sectors. So and you see where, and things really haven't changed that much, despite the fact that energy prices are up significantly over the past year. So I think how we look at it in credit, and we're a little bit lucky, I think, in this respect relative to equity, is that we don't really have to worry about a PE multiple per se, and if I'm, let's say I'm investing in this goes really for any natural resource company, but let's say I'm investing in a lithium company that the margins went from $4,000 per ton to $2,000 per ton, but they're still producing very strong margins and paying down debt. I'm still comfortable from the credit from that perspective, because we just care that we're going to get the company can service their debt and repay their debt, and is using that free cash flow to delever. So I think from that perspective, particularly as you look at the energy space, where investors may be worried about sort of the 5, 10, 15, 20 year, where the sector is going to be in 5, 10, 15, 20 years. From our perspective, a lot of these companies could repay their debt in 1 or 2 years, just based on the free cash flow that they're earning right now alone. So we don't really have to worry about where, the markets for energy is going to be in 10, 20 years. All we really care about is that we're going to get paid on our near-term debt. So that's really what we focus on. Got it.
Very interesting. Just a quick reminder for all our attendees, we have about 10 minutes left. If you have any other questions that you would like to ask our great guests, please use the Q&A tool, and we'll be happy to go through them. Meanwhile, I just earlier shared the results from the previous poll. So 80% do not take ESG into consideration when it comes to investment. Well, there's always a way to be a bit more pragmatic of that. Of course, if it strikes both of the things, great. But I think returns are equally important. I wanted to launch our last poll question. I'm going to skip one over here, but we wanted to ask our audience, which commodity are you most positive on over the next 5 years? Whether it's oil, gold, copper, lithium, or more than one of the above, or none of the above. So looking forward to see the results from our audience here. We talked a lot about energy. We talked a lot about metals and mining as well. Maybe we do a quick excursion into the other critical aspect of ESG related investment, which is food sustainability and water security. food price inflation has been on the forefront of all our minds, for the social and political impact that it has for broad population. Especially Europe is hit hard. But we see this rising trend due to the wheat exports that Ukraine has been providing to the global market, especially for emerging economies. That has been last year a big worry and a big topic. So I wanted to go into that as well for a little bit. Do you see any interesting themes in this space? Is it similar like in the energy space, that it's a mix between the old economy, so to say, and the bulk commodity agricultural space? Or is there anything, any way how you position for more sustainable food production, which is definitely also needed to achieve climate targets?
It's a question for the ages, frankly, Thomas. It's a point that gets forgotten about a lot. The reality is that our world's population is what, 7 billion people, I think now, probably growing to 8 or 9 in the next decade or so. And the reality is that all of that growth is occurring in developing countries. And the reason I say that is because what we know from our the lesson that is history is that as people's wealth increases, their diets change as well. So it's not just we need to feed many more mouths, but the type of food that is going into those diets shifts as well. So as your wealth and prosperity improves, your diet tends to shift from a carbohydrate-based diet to a protein-based diet. Now, why is that important? Well, because for every kilogram of chicken that's consumed, you need at least 2 to 3 kilograms of grain. For every kilogram of pork, you need 3, 4, or 5 kilograms of grain. For a kilogram of beef, you can need as much as 10 kilograms of feed. So the food requirements are exponential, is really the bottom line here. And why we are certainly within our funds very interested in the food space, not just from a requirement to feed people, but also obviously the animals that we'll be consuming as well. But the other aspect here, of course, is the limitations on arable land and your ability to grow said food, but then also the carbon footprint of doing so. Now, there are cultural differences I appreciate in terms of where, how diets shift, but the reality is, and you touched on it, water availability is also key. So food or ag tech is a very interesting subsector or thematic that we are very much pursuing within our funds, where we see significant opportunity around the improvements in productivity of food growth. Indeed, something that's also forgotten in terms of that decarbonisation angle is that the reality is that we've seen massive productivity or efficiency gains in the way we grow, harvest, and distribute our food over the last 200 years. But the problem is that those productivity gains have been made largely through hydrocarbons, through fossil fuels. It's the automation, it's the mechanization of our food production, and that's been through fossil fuels. And the distribution of that food, or the cold storage of that food, that's all been through mechanization and fossil fuels. So if we are to progress down this decarbonized pathway, we've got some pretty significant challenges, not just from our carbon footprint, but from how we deliver the food requirements that we will have. So again, you've touched on a very key point, and it will be a very significant investment thematic going forward over the next, decades.
Yep, no, fascinating. I do think, we have been here similar, like with some of the renewable energy stuff. We have been going through a roller coaster that was in this post-COVID zero interest rate environment, the investment fad of all the plant-based meat substitute products. I personally, this maybe I'm very biased in that sense. I don't think it's a great thing, because low barriers of entry, pretty much everybody can do it. And for those of you in Asia, Chinese and Indian cuisine has been using plant-based meat substitutes for thousands of years. Just because McDonald's has now plant-based burger doesn't make you can make billions of that. So that's
Absolutely.
one of that one. We do have two more questions in our Q&A answer. Maybe we want to go through this because we have only about 2 minutes left or 5 minutes left. But maybe I don't know. Can we do a quick round? Like what's the 12 months view of investing in energy transition, mining, commodities in general? Would you, if I understand the question correctly, like, are we keeping the allocation? Is it time to increase allocation, or with the recession outlook and rates outlook that most likely we will stay at elevated levels for some time, that it's better to reduce a little bit?
I'm a somewhat biased commentator here, given we have a natural resources fund. So, but I guess for me, that I can make the case that we've talked about the longer term thematics here, and we've also touched on clearly the short term risk with regards to recession. What I would say with regards to positioning, and indeed, your first poll question, I think was fairly indicative that the lion's share of generalist investors are either zero weight or underweight, at least, their exposure to commodities, because commodities are obviously seen as a proxy for economic growth, and rightly so. So the question becomes, at what point does the generalist investor, because as I say, we are always there, does the generalist investor change that view? I think the reality is that the lion's share of the market will be looking for signposts ahead of we are no longer in like once we are there. And I think, in many cases, China, I think for sure, as they've already demonstrated, they've had that recession impact through 2022. But the rest of the market, the broader market, will not wait for, hey guys, we're in recession, now we're going to recover. The equity market certainly will move ahead of that. And I think the weight of money effect, if nothing else, of people moving back to a neutral position will be good for commodities more broadly. But yes, as I say, I'm a somewhat biased commentator.
We're all biased, I think. Next time we should get somebody a bit more diverse here. There's one question that comes in on the allocation of commodities and the volatility of commodities. I want to take that answer to that, because I think this is something that we are spending also a lot of time on at Kristal. I think the key is always to put it into context. It is very true that commodities are very volatile, and as an asset class, it is volatile. If I take, for example, the lithium story that I mentioned early on, where some stocks sold off 15-20% in a day when news broke. Investors have to be prepared for higher volatility in that sector, and it is therefore important to take it into account as to what is your overall risk appetite in the portfolio, and optimize it for that. So we are very much looking into how does it flow into the composition with other assets that are in our customers' portfolio, and then arrive at a targeted recommendation for that segment that we have. The other more detailed question was also, how can we increase allocation subject to these two concerns being addressed? Well, I think one of the points is also what John said early on, through credits. I think, yes, credit spreads are definitely providing extra margin, extra risk premium in that segment. But ultimately it is, I think about 80% of the moves will come from the moves in overall interest rates changes, and then 20% of the returns will be from moves in a credit spread. So there is indirect allocation to that segment that can basically, how investors can increase their allocation to that sector, going through second order credit vehicles, etc. Yeah. Good. I think we are on top of the hour now. I wanted to thank you both very, very much. Oh, sorry, I haven't shared the results from the last poll. I think my apologies to that. That is maybe a great way to end this fireside chat. So our audience is favoring gold over the next 5 years with a 40% response rate on that, or more than the above with about 33% on this one. For me personally, I would also choose 2. Actually, I would choose 3. I think I'm more in the metals and minerals space, so I would choose gold, copper, lithium, my 3 favorite ones. I don't know, John, which one would you have picked?
Yeah, I'd probably say copper.
Okay, interesting that nobody else had it. Huh?
Yeah, I'm on the copper wagon too. I actually also like uranium. We touched on nuclear earlier, but yeah.
Oh yeah. Good. Thank you very much for your time. I hope also that for our audience, it has been an engaging discussion, that you found it equally interesting. As I said, any questions that we could not answer, we will try to get back to you. And thanks very much for attending. And also, John and Todd, thanks very much for taking out the time and joining us for this fireside chat. It has been a great pleasure. I hope we can do something like that in the near future as well, because I think we could spend another 2-3 hours on each of these topics. Thank you very much for that.
Thanks, Thomas.
Thanks a lot.
Bye.